All right, let's settle this. All those confusing finance terms, I'll break them down right now. 1. Fixed cost and variable cost. Fixed costs stay the same, no matter how much you produce. Think rent, insurance, or salaries. Variable costs, on the other hand, rise and fall with production or sales, like raw materials or shipping. It's the difference between paying for your office every month and paying for supplies only when you make a sale. 2. Financial leverage versus operating leverage. Now, let's talk about leverage. Financial leverage is when a company uses debt, borrowed money, to boost its net income. Operating leverage is about using more fixed costs instead of variable ones to increase profits as sales grow. Both can amplify returns, but also risk. Smart companies balance the two carefully. 3. Profit versus revenue. Here's one people mix up all the time: revenue versus profit. Revenue is your total income, the money coming in from products or services. Profit is what's left after paying all your expenses. In short, revenue shows how much you make, profit shows how much you keep. 4. CapEx versus OpEx. CapEx means capital expenditure, money spent to buy or upgrade long-term assets like buildings, equipment, or vehicles. OpEx means operating expenses, your everyday costs to run the business like salaries, rent, and utilities. CapEx builds the future, OpEx runs the present. 5. Accrual versus cash accounting. In accrual accounting, you record income and expenses when they happen, not when cash changes hands. In cash accounting, you record them only when money actually moves. Accrual gives a clearer long-term picture. Cash accounting keeps things simple and immediate. 6. Market cap versus enterprise value. Market cap is the total value of a company's shares, basically what the stock market says it's worth. Enterprise value goes deeper. It includes debt and subtracts cash to show the company's true total value. Think of market cap as the sticker price, and enterprise value as the full cost of ownership. 7. Assets versus liabilities. Assets are everything your company owns and controls: cash, property, inventory. Liabilities are everything you owe: loans, bills, and obligations. In simple terms, assets build your strength, liabilities show your commitments. 8. Gross margin versus net margin. Gross margin is revenue minus the cost of goods sold. It shows how efficiently you produce. Net margin is what's left after all expenses, taxes, interest, everything. Gross margin tells you about your operations. Net margin tells you about your overall success. 9. Return on investment versus return on equity. ROI measures how much profit you make for every dollar invested. It's about total efficiency. ROE measures profit based on shareholders' equity. It shows how well the company rewards its investors. Both tell powerful stories. One from the business side, one from the investors. 10. EBITDA versus net income. EBITDA means earnings before interest, taxes, depreciation, and amortization, basically your operating performance. Net income is what's left after everything. It's your true bottom line. EBITDA shows your potential. Net income shows your reality. Save this video. You'll need it next time you see these terms.